Welcome to Griffonomics. Imagine a world where, your sunglasses seamlessly pay your utility bills just by looking at a piece of paper.
Huh?
Or your car operates as this massive high-performance supercomputer, and your Wi-Fi router can actually monitor your baby's heartbeat without a single physical sensor.
Yeah, it sounds completely like sci-fi, but it's really not.
Right. Today, we are looking at the company that's building the foundational architecture for that exact reality. We know you're here because you embrace the persona of the learner. You want the shortcut to being comprehensively well-informed without, the overwhelming flood of raw data.
Exactly. Nobody wants to read 1,000 pages of filings if they don't have to.
Definitely not.
Yeah.
And our mission today is to unpack what the tech industry is calling the agentic AI inflection. We're doing an investigative deep dive into Qualcomm, exploring how a company historically known as the undisputed king of smartphone chips is fundamentally transforming into this diversified edge computing and AI powerhouse.
It is a massive strategic pivot.
Mm.
I mean, to map out the sheer scale of this transition, we're pulling from a very specific stack of sources today. We've got Qualcomm's Q1 2026 financial reports, their latest 10Q SEC filings, several strategic investment outlooks from top-tier analysts, and some recent really in-depth interviews with their CEO, Cristiano Amon.
And having you here to synthesize this data is crucial because as we dive into this material, we're going to uncover some absolutely staggering growth opportunities in front of Qualcomm, and this is but those opportunities are heavily counterbalanced by some severe immediate constraints that are actively choking their traditional markets right now.
Yeah, that underlying tension is really the core narrative we need to navigate for you today. Qualcomm is staring down some incredible future markets, but to realize that potential, their balance sheet actually has to survive a very turbulent, highly constrained present.
Right. So to understand where Qualcomm is going and, how they plan to fund this futuristic roadmap, we first have to understand how they currently generate their cash, and specifically how they just performed in the first quarter of fiscal 2026.
Which was huge, by the way.
Oh, massive, because if you just look at the top line paper, they absolutely crushed it. We are talking about record performance across the board, a massive $12.3 billion in revenue, and $3.50 in non-GAAP earnings per share.
Yeah, the cash engine is just humming.
It really is.
Feels-
During the quarter, they generated over $4 billion in implied free cash flow, and they immediately returned $3.6 billion of that directly to stockholders through share repurchases and dividends.
The cash generation velocity is just staggering. And it's driven by a highly specialized, really profitable dual-engine business model. You essentially have two main segments powering the entire operation.
Right, the hardware and the licensing. Exactly. First, there's QCT, which stands for Qualcomm CDMA Technologies. This is the hardware side. They design the actual high-performance silicon for handsets, automotive, and the Internet of Things. QCT is the heavy lifter here, making up about 86% of their total revenue, and it just hit a record $10.6 billion.
Okay, let's unpack this, because the way these two segments interact is just a masterclass in strategic positioning. I like to think of their licensing division, QTL, as owning the inescapable toll booth on the global wireless highway.
That's a great way to look at it.
Right. QTL represents about 13% of their revenue, but the margins are astronomical because they hold the foundational patents for 3G, 4G, 5G, and soon 6G. Practically every time a mobile device connects to a cellular network anywhere on Earth, a toll is paid to Qualcomm.
Yep, it's virtually unavoidable.
And meanwhile, QCT, the semiconductor side, is the engine factory. They're building the high-performance engines, the Snapdragon processors that actually go into the vehicles driving on that highway. What's fascinating here is how they leverage the fabless model within that engine factory to maintain their agility.
Explain the fabless part a bit for those who might not know.
Yeah, so because they outsource the physical manufacturing of the silicon to third-party foundries like TSMC and Samsung, they aren't sinking tens of billions of dollars into concrete, clean rooms, and lithography machines.
They just do the blueprints, essentially.
Exactly. Instead, that immense capital is entirely diverted into aggressive research and development. This model is the bedrock of their current transition. It allows them to scale massively and pivot their engineering focus into new AI architectures without the crippling capital expenditure of maintaining physical foundries. They invest their capital in intellectual property, which yields that tremendous free cash flow.
But, this is where the plot thickens and the narrative shifts a bit. If Q1 was a record-breaking quarter and they are generating billions in cash thanks to that IP-heavy model, why is the broader market looking at them with such skepticism?
It's a really stark contrast.
It is. Why is their Q2 guidance suddenly reflecting profound caution? That brings us right into the immediate constraints that are currently suffocating the global smartphone market.
This raises an important question. If consumer demand for premium smartphones remains relatively healthy, why are massive handset manufacturers suddenly slashing their build plans for the upcoming quarters?
Right, why stop building if people want to buy?
Well, the answer lies in a severe industry-wide bottleneck. There's a massive shortage of DRAM memory.
So the memory crisis is effectively acting as a speed limit on their QCT segment.
Precisely. To understand the mechanism here, you have to look at the data centers. Global memory suppliers are aggressively redirecting their manufacturing capacity away from standard consumer electronics and toward high bandwidth memory, or HBM.
Because that's what AI needs, right?
Yes, HBM is the critical component required to power the massive AI data centers for hyperscalers like Microsoft and Google, and honestly, the margins there are irresistible for suppliers.
So the phone makers are left out in the cold.
Exactly. Consequently, the smartphone manufacturers, especially major players in China, literally cannot procure enough memory chips to build their handset pipelines. Because of this artificial supply cap, Qualcomm's Q2 guidance for QCT handset revenues is projected to drop significantly to approximately $6 billion.
Wow.
Yeah. The 2026 handset market is being constrained by silicon physics and supply chain realities, not by a lack of consumer appetite.
And that memory shortage is compounding another massive structural overhang that analysts refer to as the Apple cliff. Apple has historically been a massive volume customer for Qualcomm's modems.
Huge.
But the planning assumption, universally accepted across the industry, is that Apple will move its modem technology entirely in-house by 2027. We are talking about a $7 billion to $8 billion revenue void that Qualcomm has to account for.
And the push for vertical integration isn't confined to Apple either. We are seeing major Android partners taking similar steps to control their own destiny. Samsung is actively working to reduce its reliance on third-party Snapdragon chips for its flagship devices.
Right, everyone wants their own silicon.
Exactly. Chinese OEMs are following suit. Xiaomi, for example, recently announced a staggering $7 billion R&D initiative to massively ramp up their internal semiconductor capabilities. They all want to build custom silicon to capture those hardware margins for themselves.
Add to that the geopolitical reality. I mean, their heavy reliance on the Chinese market introduces measurable risk to their handset revenues, particularly with ongoing tariffs and export controls.
Yeah, like the recent revocation of export licenses to sell advanced technology to Huawei.
Exactly. These trade tensions create a highly volatile operating environment that can instantly impact their quarterly projections.
It is an objective reality of their balance sheet. Operating in a highly complex, heavily regulated global environment means that geopolitical shifts can instantly materialize as revenue constraints, regardless of how good their silicon is.
Wait, if the smartphone market is constrained by memory and their biggest customer is leaving in 2027, isn't Qualcomm walking into a trap? Why isn't the leadership hitting the panic button right now?
Because the leadership team mapped out these exact bottlenecks years ago. Their escape route isn't just an idea, it's already well under construction. Management instituted a strict corporate mandate. By the end of the decade, they intend to achieve a 50-50 revenue split between their traditional handset business and non-handset businesses.
So they saw the wall coming and built a ladder.
Exactly. They are aggressively diversifying their revenue streams to ensure that when the Apple cliff arrives, they have already built the bridge over it.
Here's where it gets really interesting because the main supporting pillar of that bridge is the automotive sector. Qualcomm currently commands a $45 billion automotive design win pipeline.
It's an astronomical number.
It really is. Let that number sink in for a moment for our listeners. $45 billion in secured, forward-looking revenue. They are explicitly targeting $8 billion in annual automotive revenue by fiscal 2029.
And they aren't just dabbling in cars.
No, they are already the leading digital cockpit provider worldwide, integrated into 75 million vehicles currently on the road. We are talking about sweeping, long-term contracts. They've partnered with the VW Group to be the primary tech provider for their software-defined vehicles through the Rivian joint venture.
They're powering the Toyota RAV4 too, which is the top-selling vehicle globally.
Yeah, and they are even co-developing a highly advanced ADS, that's Advanced Driver Assistance System stack, with BMW.
The core reason they are dominating these automotive contracts traces directly back to their mobile DNA. Robotics and modern automotive architecture are fundamentally edge AI problems.
Sure, because you can't exactly fit a server rack in a sedan.
Exactly. You cannot put a massive 500-watt, power-hungry data center server in the trunk of a car. You need high-performance computing that draws incredibly low power, manages thermal output perfectly, integrates seamlessly with an array of cameras and LiDAR sensors, and processes all of that data in absolute real time without latency.
Which sounds exactly like a smartphone.
Yes. That highly constrained, high-efficiency compute environment is exactly what mobile smartphone chips were originally designed to master.
They are essentially turning the chassis of a car into a giant motherboard. The vehicle isn't just transportation anymore, it's a 4,000-pound edge server that happens to have tires.
That's a brilliant way to phrase it.
The dashboard is the interface, the cameras are the sensory inputs, and the Snapdragon chip is the centralized brain managing the battery, the infotainment, and the autonomous driving systems all simultaneously.
The transition from simple applications to comprehensive edge AI is seamless in that automotive environment. But if you can successfully engineer edge AI into a 4,000-pound vehicle, the next logical step in Qualcomm's roadmap is taking that exact same high-performance capability and shrinking it down into a 50-gram pair of glasses.
Which brings us to a massive paradigm shift. The sources detail the move away from traditional apps toward what the industry is calling agentic AI.
This is where things get wild.
Totally. We are looking at the rise of personal AI devices, smart glasses, smart rings, advanced earbuds. Cristiano Amon, the CEO, views this as a potential 10 billion device market. They are already the processing power behind the Meta Ray-Ban smart glasses.
Right, which are incredibly popular.
Yeah, and the vision here is that these AI agents won't just sit in your pocket waiting for a prompt. They will actively see what you see and hear what you hear. Eamon uses the example of holding a physical utility bill in your hand, looking at it through your smart glasses, and simply telling the glasses to pay it.
No pulling out a phone, no opening a banking app.
Exactly. The AI reads the account number, cross-references your bank details, and executes the transaction without you ever touching a screen. But okay, I have to push back a little here.
Go for it.
Are we genuinely expected to trust a pair of lightweight sunglasses to access our bank accounts and pay our bills just by looking at a piece of paper? The convenience is undeniable, sure, but handing over that level of financial autonomy and visual access to a pair of Ray-Bans feels like a massive leap of faith for the average consumer concerned about security.
If we connect this to the bigger picture, that leap of faith happens because the fundamental human-computer interface is evolving. For the last 40 years, humans have been forced to learn how to use the computer.
Right. DOS, Windows, all of it.
Yeah, we had to learn command line DOS. Then we had to learn the spatial logic of a mouse and a graphic user interface. Then we adapted to tapping and swiping on a touchscreen grid of apps. Through agentic AI, the paradigm entirely flips. The computer learns to understand us.
Ah, I see.
It understands your natural voice, your physical environment, your daily context. You aren't blindly trusting the glasses. You're utilizing a highly secure AI agent that operates locally on the edge, interpreting your natural language commands without sending sensitive financial visual data back to a vulnerable cloud server.
And the vision goes even deeper than cameras and microphones. The investment outlooks outline Qualcomm's strategy for the future of 6G. We typically think of 3G, 4G, and 5G as just, progressively faster pipes for downloading data.
Which they have been, mostly.
But 6G isn't merely about connectivity. Qualcomm is developing 6G to function as an AI-native sensing network. They are engineering radio frequencies, RF waves, to act almost like a pervasive radar system.
This is where the engineering borders on science fiction. Because 6G operates at such incredibly high frequencies, the radio waves act almost like microscopic sonar.
Like bats using echolocation.
Pretty much. As these RF waves bounce around a room, the AI can analyze the minute Doppler shifts in the returning signals to map a 3D physical environment in real time. The signals are so hypersensitive that they can detect the microscopic disturbances in the air caused by a baby's chest rising and falling.
That is insane.
I know. This means the 6G network itself could accurately calculate and monitor a baby's heart rate without a single wire, wearable, or sensor ever touching the child.
But to power all of this, these local agents, these autonomous cars, and this massive invisible sensing network, Qualcomm knows the edge computing hardware can't do it alone. They require massive, highly efficient data center capabilities and physical infrastructure to support the ecosystem.
They do, yeah.
Which brings us to why they have been on a highly targeted, aggressive acquisition spree. They are assembling a very specific puzzle.
To make the edge work perfectly, you need a hyper-efficient cloud. Let's look at their strategic M&A audit as a series of crucial puzzle pieces. They recently acquired Alphawave for $2.3 billion.
That's a big check. Why Alphawave?
Because inside a data center, moving data between chips often consumes more power than the actual computing process. Alphawave specializes in high-speed wired connectivity IP, which is the exact puzzle piece needed to solve those data center energy bottlenecks.
Makes perfect sense.
They also acquired Ventana Microsystems, which deepens their expertise in RISC-V CPU architecture, allowing them to build highly scalable, custom solutions tailored for massive cloud hyperscalers. And on the physical side, they acquired Agentic to integrate advanced AI image signal processing directly into robotics and industrial vision systems.
So they are targeting the data center AI inference market with razor-sharp focus. They are rolling out these highly power-efficient neural processing unit architectures like the AI 200 and 250 series. Market analysts are projecting this specific sector as a $5 billion to $7 billion revenue opportunity by 2027.
It's a huge addressable market.
It is, and they are also pushing hard into physical AI powering industrial automation and complex robotics with their Dragonwing IQ-10 series. But let me ask the tough question for you, our listener. Can a company that built its empire designing chips for cell phones really walk into the data center and pick a fight with absolute titans like NVIDIA and Broadcom?
It's a vital distinction to make regarding their strategy. Qualcomm is not trying to beat NVIDIA at AI training. NVIDIA completely dominates the market for training massive large language models because that process requires brute force, incredibly power-hungry computing.
Right, they own that space.
They do. Qualcomm is exclusively targeting AI inferencing. Inferencing is what happens after the massive model is already trained, when you actually put the model to work answering user queries or processing live data.
So the everyday usage of the AI?
Exactly. Inferencing doesn't require brute force. It requires incredible power efficiency to keep operating costs and thermal output manageable at scale. And power efficiency executing complex mathematics on a tiny battery without overheating is Qualcomm's historical superpower. They're taking their mobile DNA and scaling it up to revolutionize the server rack.
So what does this all mean? Bringing all these complex pieces together, we've looked at the massive record Q1 cash generation, the severe immediate constraints of the DRAM memory shortage, the looming reality of the Apple cliff, and this massive aggressive pivot into automotive edge servers, agentic AI wearables, and data center inferencing.
That's a lot to process for any portfolio.
It really is. When you synthesize the financial realities with the strategic roadmap for you, the learner, the final verdict from the investment outlooks, categorizes Qualcomm as a transitional value play.
Yeah, that's the consensus label right now.
The broader strategic consensus rates the stock as a hold or a core long-term asset. Right now, the stock is trading at a relatively inexpensive multiple of around 11.5 times earnings. To summarize this clearly, that low valuation reflects Wall Street's immediate short-term fear.
Right. They're spooked by the near term.
Exactly. The market is hyper-focused on the muted smartphone cycle, the lack of DRAM memory choking off handset production, and the impending departure of Apple in 2027. But by fixating exclusively on those smartphone constraints, the market is completely overlooking the massive $45 billion automotive pipeline, the explosive robotics design wins, and the foundational architecture they are building for the AI edge.
The transition is already happening.
Qualcomm is currently navigating incredibly treacherous waters, but they are utilizing their immense cash flow to fund and build the infrastructure for the next decade of computing.
And as we look toward that next decade, consider this final provocative thought. As 6G evolves into an AI-native sensing network acting like microscopic sonar, reading our environments, our movements, and our vitals purely through radio frequencies bouncing through the air, does the concept of a physical device even matter anymore? Wow. If the very air around us becomes a pervasive sensing and computing network, we won't be carrying computers in our pockets or even wearing them on our faces. We will simply be walking through them.
Risk defined. Portfolio protected.